This week, more than $1 trillion got wiped off semiconductor stocks in a single session. Nvidia, AMD, and Micron all got pulled into the same sell-off. Some of that is genuinely just macro, when the Fed sounds hawkish, or when investors rotate out of high-growth technology broadly. Even companies posting excellent numbers can get dragged down together, simply because they all sit in the same trade. But that's not the whole story here. If you actually look at what each of these three companies most recently reported in their own latest quarter, on their own separate fiscal calendars, you'll find something that should surprise you. None of them missed earnings. None of them gave bad guidance. All three are growing faster than almost any large company in history. So, why is everyone panic searching whether to sell? Marcus, wait, if the earnings were good, why did the stocks fall? Priya, that's exactly the question this video answers. And the honest answer is different for each of these three stocks. They're not falling for the same reason, and they're not the same kind of risk. One quick note before we dig in. Nvidia, AMD, and Micron all report on different fiscal calendars. So when we walk through each company's latest quarter, we're talking about three separate reporting periods, not one shared moment in time. By the end of this video, you'll understand exactly what kind of bet you're actually making with each one, based on their real numbers, not the headlines. Let's start with Nvidia, because its situation is genuinely the strangest of the three. Nvidia just reported its fiscal first quarter results, revenue of $81.6 billion, up 85% year over year. Data center revenue alone hit $75.2 billion, up 92%. Earnings beat Wall Street's estimate. The company raised its dividend, approved an additional $80 billion in buybacks, and gave guidance for the next quarter of $91 billion in revenue, which assumes zero data center compute revenue from China. Marcus, that sounds like an incredible quarter. So why is Nvidia actually the worst performing major chip stock this year? Priya, because of something called by the rumor, sell the news. Nvidia's stock had already climbed about 14% heading into that earnings report, on the expectation that it would be enormous. When the results came in exactly as strong as expected, there was very little room left for the stock to react positively, because the good news was already priced in. On top of that, CEO Jensen Huang said publicly that Nvidia has, in his words, largely conceded China's advanced AI chip market to Huawei, and the numbers confirmed it. Data center revenue from China was effectively zero this past quarter. Here's the part that should genuinely catch your attention. Nvidia is trading at roughly 22 times forward earnings right now. Its own 10-year average is around 54 times. Its 5-year average is around 62 times. This stock has not been this cheap relative to its own earnings history since before the AI boom even started. Marcus, so Nvidia got cheaper while getting bigger and more profitable? Priya, that's the honest paradox here. The PEG ratio, which compares valuation to growth rate, sits at roughly 0.44 for Nvidia. A PEG below 1 generally means a growth rate justifies the price, and below 0.5 is considered unusually attractive. The real risk with Nvidia isn't that the business is struggling. It's customer concentration and the China situation. Over 90% of Nvidia's revenue now comes from data centers, and the company has essentially written off its second largest potential market in that segment. There's also a longer-term competitive risk worth naming. Nvidia's biggest customers, companies like Amazon, Google, and Microsoft, are increasingly designing their own custom AI chips to reduce how dependent they are on Nvidia hardware. That's still early and hasn't dented Nvidia's numbers yet, but it's a different kind of competition than AMD or Huawei, because it comes from the very companies writing Nvidia's biggest checks. If the AI build-out ever slows even slightly, or if China develops a real domestic alternative through Huawei, Nvidia has the most exposure of any company on this list, because it has the least diversification. Now let's talk about Micron, because this is a completely different kind of story, and it's the one generating the most panic searches right now. Micron just reported its fiscal third quarter results, and these numbers come straight from the company's official SEC filing, not an estimate or a projection. Record quarterly revenue of $41.46 billion, up 346% year over year. Non-GAAP earnings per share came in at $25.11, beating estimates by more than 20%. Gross margin hit 84.9%, more than double what it was a year earlier. The stock jumped as much as 16% after that report. And yet, just days before this report, Micron had already fallen 13% in a single session, and it's been one of the most volatile stocks in the entire sector. Marcus, why would a stock with numbers that could be the one everyone's most nervous about? Priya, because of how far it's already run. Micron is up more than 260% since the start of this year, and over 760% over the past 12 months. When a stock moves that much, the question stops being, is a business good, and becomes, is all that good news and a lot of future good news already baked into the price? Micron signed 16 long-term supply agreements covering roughly half of its expected future revenue, which gives real visibility into future demand. The company also guided next quarter's revenue to $50 billion, well above what analysts expected. Management has said tight supply and demand conditions in memory chips should persist beyond 2027. So fundamentally, Micron's business is firing on every cylinder. The panic here isn't really about Micron's numbers. It's about position sizing and timing. A stock that has gone up roughly 8 times in a year carries a very different kind of risk than a stock that's merely growing. Even small disappointments, or even a stable quarter that simply matches sky-high expectations, can trigger sharp pullbacks, the same way it briefly happened with Nvidia. The business is strong. The volatility around that strength is real and should be expected to continue. Now for AMD, and this is where the story gets the most genuinely uncertain of the three. AMD's most recent reported quarter, its fiscal first quarter 2026, brought in revenue of $10.25 billion, up 38% year over year, beating estimates. Data center revenue rose 57%. The stock jumped 16% on the news. CEO Lisa Su raised AMD's own long-term server CPU market estimate from $60 billion to over $120 billion by 2030, citing demand from agentic AI workloads that need significant CPU compute alongside GPU compute. Marcus, that all sounds genuinely positive. So what's the catch with AMD specifically? Priya, the catch is entirely about price relative to growth, and this is where you'll find real disagreement even among data sources, which is worth being upfront about. Depending on which data provider you check and how they calculate the fiscal year, AMD's forward price-to-earnings ratio is reported anywhere from roughly 60 times up to as high as 97 times, with one detailed Motley Fool analysis specifically using the 97 times figure to argue that AMD's valuation has outrun its fundamentals compared to Nvidia. Even using the more conservative end of that range, AMD trades meaningfully more expensively than Nvidia does, despite Nvidia actually growing fast in percentage terms. Marcus. So the market thinks AMD deserves a premium, but the math doesn't obviously support it. Priya. That's the tension, and reasonable analysts land on both sides of it. AMD's data center revenue is growing fast at 57%, but it's growing from a smaller base, with data center making up only about 56% of total revenue, compared to over 90% for Nvidia. That actually makes AMD more diversified, which some analysts view as a genuine long-term advantage, since the company isn't entirely dependent on one category of spending. But diversification also means AMD's data center growth rate has more room to reaccelerate from here, which is exactly the bet embedded in its higher multiple. If AMD's data center business keeps compounding at this pace into 2027 the way management is projecting, the current price could look reasonable in hindsight. If growth merely matches Nvidia's slower by comparison trajectory without AMD closing the gap, today's multiple will look stretched. So here's how these three stocks actually compare side by side based on what we just walked through. Nvidia is the largest, most dominant, and currently the cheapest relative to its own growth and its own history. Its main risk is concentration. Nearly all of its revenue depends on one category of spending, data centers, and it's effectively been shut out of a major market in China. Micron has the strongest near-term numbers of the three, with record revenue, record margins, and contracted future demand. Its main risk isn't the business itself. It's the stock's price after an extraordinary 12-month run, which makes it more sensitive to any disappointment, however small. AMD has real, accelerating growth and a genuinely larger addressable market opportunity than the company itself believed a year ago. Its main risk is valuation. Depending on which numbers you trust, you're paying somewhere between 60 and 97 times forward earnings for a company growing slower in percentage terms than Nvidia, which trades at roughly a third of that multiple. Marcus. So which one should someone actually buy? Priya. That's not a question this video or anyone honestly can answer for you, because it depends entirely on what kind of risk you're comfortable holding. If you're worried about a single point of failure, Nvidia's China exposure and customer concentration is a thing to watch closely over the next 2 quarters. If you're worried about buying after a massive run, Micron's earnings reports going forward, especially any signs of memory pricing softening, are what matters most. If you're worried about paying too much for a story, AMD's actual data center revenue growth rate over the next year either closes the valuation gap with Nvidia or it doesn't, and that will be visible in the numbers quarter by quarter, not in headlines. What ties all 3 of these together is the same lesson. A stock falling in a broad sell-off tells you almost nothing on its own. The earnings, the valuation relative to growth, and the specific risk each company actually carries. That's what tells you something. 3 companies, 3 completely different reasons to be cautious, and 3 completely different reasons a long-term case could still work out. If breakdowns like this, the kind that actually separates the panic from the numbers, are useful to you, subscribe.